Oil tanker stocks, very popular among YouTubers, commentators, and investors, have been crashing recently, and at the same time, oil prices are recovering. What's going on? So in this video, I want to discuss what's the relationship between oil tankers and oil, why oil tanker stocks usually fall when prices of oil recover, and what may happen to oil, and will oil tankers benefit or will not benefit from oil's next move. And I also want to discuss my favorite oil tanker stock. So strap in, it's going to get interesting, and if you like this video, give me a thumbs up, share and write me some comments. I'm always eager to hear from you. Let's start. When on April 20th, 2020, oil prices fell into a negative territory, I immediately started to think about which stocks could benefit from this. There is way too much oil out there and absolutely nowhere to store it. In fact, as absurd as it sounds, when oil dropped below zero, people were literally ready to pay money to take it off their hands. Unbelievable. So I thought oil tankers must be the obvious beneficiaries in this scenario. In fact, in my video about oil crash, I listed 6 oil tanker stocks which could benefit from this recent crash in oil, but I did say to be careful with them and wait for the pullback. A few days later, after I posted my video, I saw all kinds of YouTubers, investors and commentators on CNBC, Bloomberg and other media sites talking about oil tankers and how tremendously they can benefit from this environment. And I'm not saying that they had stolen this idea from me, not at all. I'm just saying that the idea entered many people's heads at the same time, and many investors also started thinking of oil tankers just like me. Indeed, oil tankers could benefit from the current oil glut. However, there is one little tiny issue with this, and before you invest in oil tanker stock, you really need to fully understand the relationship between the oil tanker business and the price of oil. Let's take an example. Let's say you can purchase a nice vintage car for $10,000 today, and you're pretty much sure that you can sell this car for $50,000 at an auction in 6 months. That's $40,000 profit. Wow, that's awesome, right? What an idea. But the issue is you need to keep this car in a safe place for 6 months before the auction. So it makes total sense to rent out a garage for, let's say, $1,500 a month, because in the end you will still make a big profit. But if this car costs you more than $10,000, let's say $40,000, then renting a garage for $1,500 would be very expensive. So you will think twice before going through all this trouble for such small profit, or you will try to find a cheaper garage. If we apply this example to oil and oil tankers, then oil is your vintage car you want to buy today and sell in 6 months, and oil tankers are the garages where you want to store oil during those 6 months. So obviously, if the price of oil today, which is called the spot price, is significantly lower than the price of oil, for example, in 6 months, then it makes total sense to rent those garages, aka oil tankers, and it even makes sense to pay them more money to store oil. But if the spot price of oil goes up, then there is less spread between today's price and 6 months price, so it makes less sense to spend that much money for an oil tanker. So a few weeks ago, when oil went negative, the positive spreads between the spot price and future contracts, which also called contango, were reaching $50 to $60. So it was a spectacular opportunity for deep pocket investors and oil traders to lock in those prices and rent oil tankers even at ridiculously high daily rates. But in the past few days, hopes for reopening economies and OPEC cuts on May 1st have dramatically narrowed the spreads between spot and future prices. For instance, the current difference between June and December WTI crude prices is only $7 per barrel, so to pay $200,000 a day for an oil tanker just doesn't make sense anymore. But it certainly did make sense when the spread was $50 to $60. Therefore, the relationship between oil tankers and oil is simple. The higher the spot price of oil, the smaller the spread between the spot price and the future contract price. If the spread is smaller, then the buyer of oil contract makes less money and therefore pays the oil tanker less to store it. But if the spread becomes bigger, then the buyer of today's spot price can make more money, hence can pay an oil tanker more. So what will happen to oil next, and will oil tanker companies benefit? Just recently, Nordic American Tanker CEO came on Jim Cramer's Mad Money and said he has never seen such a strong demand for oil tankers. He also indicated that they are charging as much as $70,000 a day for their Suezmax tanker, which can store around 1.1 million barrels of oil a day, and that's considered to be cheap. By the way, the cost to operate the Suezmax tanker is only $8,000 a day, which means they're making 875% profit. So yes, these oil tanker companies are making a killing right now. However, the question is, will this paradise continue for them in the future or not? Well, it depends on future volatility in oil prices. The recent recovery in oil indicates to me that even though there is too much oil in not enough storage, at the same time the market can self-regulate itself. A lot of CEOs of well-known oil companies came out and said that they will not sell oil at these basement prices. So the only way for the industry to come back into balance is for producers to start shutting down more wells. As you can see, according to this latest Baker Hughes rig count number, American producers shut down almost 60% of its wells compared to last year. Plus, don't forget that OPEC cuts did go into effect on May 1st, 2020. That means that oil prices are stabilizing recently, which is not such good news for oil tankers. Pretty much, if the spot price of oil goes significantly higher, which is happening right now in May, the spreads between the spot price and the future contract price, for example 6 months from today or 12 months from today, becomes narrower. That means it makes less sense to pay abnormal rates to oil tankers to store oil, and that's why oil tanker stocks have been hit hard recently. However, there is good news too. Even with these spreads, oil tankers do make money and are very profitable. Therefore, this recent downward price movement for oil tankers does provide an attractive entry point in some of them. The oil tankers are still in a very favorable and profitable environment, but they are just not as profitable as before, when the spot price of oil was trading in teens or single digits, not even to mention below zero. At the same time, I expect oil tankers to continue to benefit from this deep contango environment in months to come. So which oil tanker company do I like the most? You may think that because I just talked about Nordic American Tankers, that is going to be the company I want to discuss. Well, even though I consider NAT to be a good stock, there is another company that I've found which I like a lot more than NAT. This company is Frontline Ltd, stock symbol FRO. Take a look at this data from Clarksons and shared by Nordic American Tankers for the week of April 17, 2020. For comparison, I highlighted the daily rates for the largest ships, called VLCCs, for 2019 and for the week of April 17, 2020. As you can see, the difference is enormous. I mean, there's a big rate hike compared to 2019 for all types of ships. But big VLCCs likely will benefit the most. So obviously the companies that have the biggest number of those big ships in their fleet which are not under contract may benefit in a big way. But in my search, I also wanted companies to have a somewhat diversified mix of ships in their arsenal. So when rates for big ships drop, smaller ships can pick up the slack. I thought that Frontline fits those parameters well. What I like about them is that unlike Nordic American Tankers, which carry almost exclusively Suezmax type ships, Frontline has a pretty diversified fleet and they carry a large number of VLCCs, which are the largest ships. As of December 31st, 2019, they have 19 VLCCs. These are humongous tankers that can carry up to 2.2 million barrels of oil, 26 Suezmax tankers, mid-sized tankers that can carry up to 1.1 million barrels of oil, and 18 FROmax tankers. Those are smaller sized tankers that can carry 800,000 barrels of oil. If you look at their stock price to earnings ratio, it's sitting right around 11, which is a discount to other big oil tanker companies. But take a look at their forward PE. It's ridiculously low and it's sitting well below 3 right now. Their debt to equity level is a bit high, but hopefully with this recent spike in daily rates, they will be able to pay off a big portion of that debt soon. The stock carries over 17% yield, and even with daily rates dropping pretty significantly in May, they're still making a lot of money and should be able to sustain Maybe if not the same yield, but a significant portion of that. Therefore, even though the oil tanker stocks have been crashing lately, they still have a future, and maybe that crash could be used as an opportunity to get in on some of them. Do you guys own any oil tanker stocks? Let me know in the comments below. Don't forget to subscribe, and I'll see you next time.